to everyone who's here, and we're going to get started on, let me just hide this control, make it a little better. Going to get started on this quarterly review, which is the May quarterly review this year, 2024, and I'm going to also just spend a couple of minutes going through some of the things that the budget brought out. And there wasn't really a great deal of substance to or end impact from that, but well, let's just cover it off while we're here. But let's have a look at what's happened in the markets, because it's been an interesting time, as most people know, in terms of what's happening in the interest rate settings, monetary policy, how that's impacting the economy, and lots of moving levers, I suppose, everywhere. Just trying to get rid of these. Okay. So everyone can read the disclaimer, and people who have been to our reviews previously would know about those. This is general information, so it's not designed to perform anything like give specific advice for people in their own circumstances. General information. If you need any advice, don't hesitate to reach out. For anyone that doesn't know, just a brief recap of some of our businesses and what we actually provide to our clients, and those clients may be situated in Australia or anywhere around the world, because Wise Guru is our international consulting business. It specialises in helping Australian expats, no matter where they are around the globe, in assisting them invest in Australian property, refinance or establish their lending capacities. We try and assist people with the whole process, I suppose, because it is even more difficult when you're doing it from offshore than if you're doing it in Australia, where it's difficult enough. We then have the other businesses. Unicorp Partners is the financial advisory business that's situated in Sydney and helps professional people, medicos, lawyers, etc. Within Australia and Australian expats around the world, especially with their repatriation concerns or issues, or if they're moving from Australia to live and work overseas in another location. Aussie Loan Guru is our lending business, and we'll go through that later, but we have some very unique attributes within that where we can help our Australian expat clients around the world with up to 85% loan-to-value ratios without them having to pay mortgage insurance. That can be really important if you're trying to buy a property or increase your property portfolio and use some of the equity that you've built up in the existing one. So really good stuff there. And Aussie Property Guru is the Australian real estate business. So that's really just a brief run through, and we can touch on some more of those points as we go through things. But if we look at this, our clients typically earn higher incomes. They're very time poor, and I think most people, whether they're a medical specialist in Australia or an expat banker or other professional around the globe, will recognise that we're all really very time poor. Most of our clients want to build wealth in an affordable and tax-efficient manner, and they want to include some real property within that, I suppose, as they're building up their asset base, and they want to make better informed choices. But as we go back to the time poor situation, most people don't really have the time to do the due diligence and research on their own, because it's just too much of an impost on what little spare time we do have. So if we have a look at how we can help clients, we've developed a concierge service which effectively takes most of the sting out of what people need to do when they are looking to purchase a property in Australia. It's covering just about everything in terms of financing, assistance with a whole range of other professionals within the legal scope, within property management, within accounting and tax and so forth. So we can at least perform the function of coordinating those services for our clients, and obviously assisting them with the selection, I suppose, of properties that may suit their particular personal set of circumstances, depending on how their existing portfolio looks now. And we charge a fee for that at settlement of a property, which is $4,950 Sing dollars. So let's have a look at this. We put the slide up on every review. What are the most common questions we're getting asked? And they still revolve around interest rates. However, there's been a nuanced change in the last 3 months where people are not just asking, when will the RBA start cutting interest rates? It's, people are concerned that perhaps the central bank may have to increase interest rates because of sticky inflation. So that leads into that question, well, we've got a fixed rate loan that's rolling off fixed rate or has done recently. Should we fix our rate again now? Then the other one is, of course, how will these higher interest rates impact property prices? Because most people and many economic commentators have said that property prices would be severely impacted on the downside due to the higher interest rates, and really the opposite probably has occurred. So then people are saying, well, look, which markets are going to provide us the best growth opportunities, both in the short term, but more importantly, I guess, in the long term. And there is still quite a lot of discussion at the moment about work from home. So I was talking to a client yesterday, and he's recently moved from Singapore to Australia and has noticed a big change that in Australia, work from home has taken on a far more, I guess, permanent, if you like, situation within the workplace where employers can't just get their employees to come back, as in perhaps certain other jurisdictions, and Singapore is one of those, where certainly people in the banking sector are being forced to go back to the office. Important question as well is, will rents continue to increase or remain at these high levels? And this is particularly important because people are struggling a little with meeting the extra interest rate imposts on their monthly loan repayments. And then last but not least, I suppose, it's very important is, where are the centres of high population growth, and also how set is that? How long is that going to remain in place in certain locations, or is it going to be something that's more short term and comes and goes? And these are the sort of things that we look for when we do our research, and hopefully we can answer those questions as we go through, but they are pretty important ones. So let's turn to the federal budget that was just handed down last Tuesday. And in real terms, look, there wasn't a great deal in this budget. There's been a lot of talk in the media since then that it's an election budget and, we're helping everyone with cost of living increases, etc., etc. But in reality, the budget didn't do a great deal, and some of the headline splashes that were there, the stage 3 tax cuts really were already agreed upon, and the Labor government amended those not so long ago so that the tax cuts would be reduced for anyone on the top marginal tax rates, but increased to some extent to the rung below that. The other big thing was this thing about energy relief. Now, this should be put into context. Everyone is going to get a $300 rebate, that's per year, and that's going to be paid quarterly. So, $75 a quarter that's being paid to your energy provider, I don't think is going to make people race out and spend all of that money or more and create an inflationary impost. Similarly, businesses will get $325 in their energy rebates. So I think, when people say this budget is inflationary and it's going to lead to the Reserve Bank having to raise interest rates, I don't actually believe that. I think it's wrong. I think, if anything, it's going to help in terms of some of the portions of the inflationary basket that are impacted, and I think it'll actually bring that inflation down. The other part is that there's going to be an increase, as you can see at the bottom of your screen. The maximum Commonwealth Government rent assistance will be increased by another 10%. So I think that's really important because rental costs obviously feed into the inflation basket in a fairly major way. Superannuation will be paid on parental leave payments, and there's a freeze on social security deeming rates. So I think, all of those things are important. The $20,000 instant write-off for assets for small businesses will be taken through till the end of 25. And there's, as I said, the freeze on social security deeming rates. But all of these things, they're not mind-bending outcomes. So the other thing that's probably pretty important for most Australian expats, and we've had lots of questions about this over the months and years, there was no announcement in relation to the modernisation of the individual tax residency rules. And most people will refer to this as the 45-day rule, where it has been brought out, as we know, in the 21 budget, that anyone spending more than 45 days in Australia may be subject then to a 4-factor bright line test and potentially be deemed an Australian tax resident. So just to be clear, there has been no mention on that, as I thought there wouldn't be, because I think the government has enough real issues to deal with at the moment rather than this. And what that would mean from a practical viewpoint is that this is going to be pushed out, one would assume, at least to the then following tax year for any direct impact to be felt, if indeed it will be brought in the current situation, or in the current, I guess, format. There's been a lot of lobbying. We've done lobbying in relation to 45 days not being a realistic time frame, and it should be at least 90 days plus to allow individuals to work in Australia or visit their family, or a combination of the two. And the graph at the bottom of your screens is really just to highlight what's happened to the new tax rates and the tax cuts that came in. As you can see there, the changes in red, 18,000 to 45,000, the tax rate's now 16%, and then there's been an increase in the bands. So particularly interest is 120 to 180,000, goes from 135,000 to 190,000 at 37%. So the individual tax rates have been improved for everyone. However, what we really need to bear in mind is that this only brings back about 18 months worth of bracket creep that's occurred. So, again, it's really just taking with the one hand and giving with the other, but we'll take all of that gratefully. But I think future governments, or this government in the future, need to actually come up with some real tax reform. This is just playing at the edges. We know Australia's a big country, and as I said earlier in the questions, research is a really essential component if you're going to invest in Australia, because there are just so many different property markets around the country, and then within those, of course, there's even more granularity. So it's something that we do. We use government data, obviously, supplied by the ABS, the Australian Bureau of Statistics, Population Centre. We use national research houses like CoreLogic, Oxford Economics, and others. But what we have to recognise is that these businesses provide a lot of statistics, a lot of data, but you've got to actually then use some experience to help with a practical overlay and put all these things together to hopefully come up with an outlook that we can assist people with, that's going to be more genuine in terms of what occurs, rather than just looking at it from an academic viewpoint. And unfortunately, a lot of commentators tend to do that these days, and they will miss, I suppose, many opportunities that exist within markets that are not just an investment market. Housing is something that people actually utilise from another viewpoint, and that's to live in. So interest rates, when will they come down? Or a lot of people say now, when will they go up? Well, let's have a look. You can see that the RBA at its latest meeting left the cash rate on hold at 4.35%. as I thought they would. And at this point in time, I think the board is actually performing a reasonably good function. They're not being frightened by rogue numbers or numbers that come in hotter than expected. And the month before last, unemployment dropped to 3.8%, so everyone jumped on the bandwagon where rates are going up. The latest numbers back up to 4.1%, and I think the RBA is doing a reasonable job at the moment, and there are a lot of people just trying to grab headlines. But in my mind, I think the RBA, unless something really untoward happens in terms of economic data, will remain on hold until we get a cut. And I think we'll go through it shortly, but I think that cut may come in the December quarter. So if you have a look at what that means for us as retail borrowers, interest rates have remained pretty steady for all borrowers, and what I mean by that is people who are homeowners who live in them, so owner-occupiers or people who are looking for investment loans. And as we can see, if you look at the variable rate, it's remained pretty steady. It's that bluey-green aqua line there. Fixed rates, some banks have been dropping fixed rates over the last couple of months, I've noticed, and some other lenders have been increasing them. So at this point in time, as I say to most of our clients, I think remaining on a variable rate is probably the best course of action, the most conservative approach to take, and just wait to see what transpires. Then this is what I believe is really driving this, and we've brought the slide to people's attention. On the left-hand side, you see this is the share of fixed rate loans that Westpac has and that are rolling off. And if you can see there, by the December quarter of this year, you're going to have roughly 86.96% of the fixed rate loans with that bank are going to have rolled off. And it's a very similar situation with some of the other banks, so perhaps even higher. But on the right-hand side, and I think this is what people really need to be aware of, is that in Australia, as you can see there, we're one of the lowest fixed rate nations around the globe. So in America, just about everyone has a 30-year fixed rate loan. And what's happening there, and I think it also explains the strength of the American economy, is that most consumers who have a loan at 3% odd are not going to move homes and get a new loan. So they in fact have more money to spend because wages growth is occurring. The tax that Americans pay is less than the tax that Australians pay, and they've got more money to spend. Whereas in Australia, where most people are now on a variable rate, and we're paying 2 plus times what people in America are, obviously that's having an impact on that cohort of people that have a mortgage, and that's about a third of all Australians. So it's something that's really worth bearing in mind, and thereby not getting spooked too much if you have some data cut through that may be on the hot side. So if you have a look at that there, rates effectively in Australia have increased more than any other country, and our debt servicing levels are at a record high. And that's something that is having an impact on the economy, and you can just see it on the ground, speaking to people in business, in different businesses, and to individuals. It's not as easy to replace a job these days. People are struggling with, especially discretionary spending. It's been cut down massively, as we can see by, the problems that the retail sector's having, the F&B sector. It's the non-discretionary items that are really, keeping this services inflation high. So insurance premiums are a big one, rental prices, the things that, energy costs, so the things that people have to have rather than the ones that they can say, look, they can make a choice. This is the forecast from Westpac, and what I'm thinking is pretty much in line with this to a large extent. So I think we will get a reduction in the cash rate in the December quarter. So that may come in November. Let's see what transpires there, and then continuing rate cuts through the course of 2025, which will potentially bring the cash rate down to 3.1 at the end of next year. I think that is the way things are going to go. It's always subject to black swan events or things happening that are perhaps not baked into some of these numbers. But if you join our quarterly reviews, we'll try and keep you up to date about what's happening, and certainly our thought process on it all. And the other thing that people from overseas, obviously, so Aussie expats that are earning their incomes in, say, US dollars or pound sterling or Hong Kong dollars or Singapore dollars, look at, and that's your currency exchange rate. So if you look at it there, currently the Aussie dollar is about just under 67 cents today as we speak. It's forecast by Westpac to sort of remain around those levels till the end of the year, and then start creeping up during the course of 2025. I think a lot of this is going to be driven by the strength of the US dollar more than anything else, because, pardon me, if we look at the global economy as it stands now, and a lot of that's potentially being driven by the US economy, it is expanding. There is still a fair bit of demand out there. And as we've seen in the last month, finally China is stabilising, and I think will also push that demand button, and especially for commodities. So amongst other nations, India I think is going to be an important contributor to that as well. So I look at commodities and I think that's going to be a nice, fairly robust tailwind, I suppose, for the Australian economy, and that will also benefit the Australian dollar from both a US viewpoint and a trade-weighted index viewpoint. So I think, if anything, those numbers there, perhaps the Australian dollar can outperform the numbers that Westpac are suggesting it may do. But most importantly, I think most people could recognise there that our view is that interest rates will come down and will start later this year. So another thing that some people who want to grab headlines keep banging on about is that the Reserve Bank's got to do something and keep rates high, because look what's happening to house prices in Sydney. Well, if you have a look at this, house prices in most parts of the developed world have been going up, and they've been going up relatively strongly, and that's against the backdrop of increasing interest rates. And as you know, the US has probably raised those the most. So it's something that we see everywhere. It's not something that's baked into the Australian economy or the Australian housing markets. Just going to get rid of this, bear with me. So what's driving that? Well, many factors, but one of the most important ones is population growth. And we are experiencing a really high level of net overseas migration at the moment, the highest we've seen in Australia really ever. And if you look at that, overseas migration grew to a record inflow of 765,900 people. That's a lot of people in the previous year, and this is the latest data, goes to September. Australia's population is growing rapidly, and as we've been saying over the last 2 to 3 years now, during COVID and post-COVID, we thought that this elasticity would creep in and unleash itself, and it has done. So it's the largest annual increase in Australia's population again, and it will be interesting to watch the next quarter. I think things are coming into play that will start perhaps just moderating that and then moving it downwards. Again, post-budget, the Coalition have come out and said that they are going to fix the housing problem by reducing overseas migration and overseas student intakes. I can go through that with anyone in great detail, but I don't think that's actually going to make much of a difference, because most of the people that buy homes in Australia are already living, migrants who are already living in Australia. And so, if we decrease the intake, the official intake from 185,000 to 140,000, it's actually not going to have any significant impact in my mind. So this is the latest data. On the right there is to September 2023, and it's just showing that the existing trends are still happening. Western Australia's had the fastest rate of population growth in the last quarter, in that quarter, September quarter, 3.1%. Then followed by Victoria 2.7, Queensland at 2.6. So, as you can see, WA and Queensland have been the sort of leaders in if you like, interstate migration, and Victoria is now moving up, and a lot of that's driven by overseas migrants. The other area that we look at is what's happening in terms of lending for property purchases, because that also gives you an idea of what's happening on a more macro level. And if you can see there, lending for investment, that's the orange line, has been moving up, and that excludes refinances. But overall, value of lending rose just over 3% through March, and that was a 4.4% lift in first home buyer financing, which is nice to see, and 3.8% rise in investor finance. It's a pretty strong figure, and March was the strongest monthly figure, as you can see there, since August of 2022. So that means that the property markets around the country are quite strong. It's a robust situation. The other thing that we look at, and a lot of economists obviously look at, is what they term as the riskier type of lending. And that can mean many things, but generally speaking, it's interest-only lending, higher LVRs, loan-to-value ratios, higher DTIs, debt-to-income ratios. But generally speaking, as we can see there, mortgage originations, so that style of lending, remain near historic lows. And they're saying some lending policies are relaxing a little. Well, we deal in the space on a daily basis, and I certainly haven't seen that. I think it's something that should potentially come to pass, but I think the RBA and the regulators will look to see what's going to occur over the next few months in terms of that services inflation before they make any moves there. And I think it's potential that APRA could come in, and I think they should come in and move on the buffer rates that banks need to apply to people's borrowing capacities at the moment, because typically if you're going to get a loan now, the bank is going to assess you at roughly 10%, and I think that's just too high when we are where we are in the current interest rate cycle and environment. So let's have a look at property as an asset class. It's a pretty important one. As you can see there, it really underpins a lot of Australia's wealth, and it's moved now $10.6 trillion. And the important thing is, I note to people, because some people don't recognise this, especially Aussie expats, there's only $2.3 trillion worth of mortgage debt outstanding against that. So it's actually a very low, it's a lowly leveraged situation. And a lot of people forget that because they think everyone's in the same boat as they are. But that's, I think, one of the problems at the moment, is that we have this high interest rate environment. A lot of the people that don't have any debt, don't have a mortgage, so that's the typically older cohorts, that perhaps 65 plus, are getting so much more disposable income through these higher interest rates, because they generally have funds on deposits in various different mechanisms, whether that's via superannuation or not, and that's giving them more money to spend. So when we look at some of the underlying numbers, we see that that cohort's actually continuing to spend more on discretionary items, whereas everyone else isn't. So too many moving parts to just move one, unfortunately, and have the impact that we're seeking. And it's something where I believe the Australian government needs to come into play, and fiscal policy is very important, because that can be directed at certain sectors, whereas monetary policy is a very blunt instrument, as people know. So we're looking at property. Here are the national home values, and they've increased 8.7% over the last 12 months. As you can see, on a quarterly basis, they're up 1.8%. But it's important to look at, if you look on the right there by quartile, over the 3 months to April, the lower quartile rose by 3%, whereas the upper quartile lifted by 1.1%. So there's quite a bit of discrepancy there. And if you have a look at this situation, it also shows that we're seeing growth between different dwelling styles changing. So you're looking here now at units increasing in value at a far quicker rate than freestanding homes. And I think one of the reasons for that obviously is the affordability situation. So freestanding homes are, generally speaking, now relatively more expensive, and I think that's probably going to mean revert somewhat over the next few quarters, where people are buying apartments because A, they are more affordable. But what I think we also need to remember is that certain demographics, like downsizers, are looking to do that due to other features, amenities, security, etc. So both of those things, I think, we're going to see that coming through, I think, more as we go over the next few months. So let's look at different markets, because they are really, very divergent. And if you look there, Perth, as you can see, Adelaide and Brisbane are the smaller capitals that are really performing very strongly. Melbourne's actually has been quite weak, and it's been weak for probably the last 12 months. And then if you look at the regionals again, regional WA, SA and Queensland are the strong performers. So it's state-based, and I think a lot of that potentially is being driven also by interstate migration patterns. If you have a look at the different quartiles of the value quartiles within dwellings, then that's a pretty good slide, and it just shows people what's happening there. So the lower quartile being the yellow one and the upper quartile being the orange one. As we can see, that growth is really strong in Perth, Brisbane and Adelaide, and then the smaller capitals, but also Melbourne, as you can see there, is actually showing a negative number for the upper quartile and pretty flat otherwise. So it's something that you need to look at, and that's why I'm saying research is so important, and you need to look at it in a pretty granular manner, because people quite often say, what's the next best suburb to buy in, or have some sort of generic flavour to that question, where you really need to look at a lot more to make it worthwhile from an investment viewpoint potentially. Now, I think this is the main, this is really the important one, supply and demand. And whilst dwelling approvals were up 1.9% in March, that was driven by 3.6% increase in house approvals, and it outweighed the 1.8% decline in unit approvals. Terrific, great data, statistics, etc. But what's really important, I think, is if you have a look here at the orange line, this has just been coming down and down and down for a long time. And what the problem within the Australian housing markets is now is that the amount of supply is just so low. And that's a factor of many things, but high interest rates certainly, higher land values, higher construction costs, and the ability to obtain personnel to actually build your place those are the biggest problems, and they're not going away anytime soon. So this sort of continued very subdued development application level is going to remain with us, because people just cannot build new dwellings on an economic basis, so they're not going to. As you can see there, March results over 2% below last year, and nearly 25% below the decade average. So that's a problem, especially when we continue to grow the population. And I don't think stopping that is going to increase supply. So when people say, well, stop the immigration, well, terrific. but that's not going to build new supply, and we've already got too many people by far to meet the current output. So if we look at, if you look at that slide, Australian dwelling approvals have continued, this goes to beginning of 23, they've continued on that slope, and this supply-demand imbalance, I think, is not going to go away for the medium term. I know the government has said that they're going to build sufficient new homes over the next 5 years, but I don't think anyone else actually believes that to be a potentially achievable outcome, and the numbers we look at on a quarterly basis support that. So we're not going to be building enough dwellings. There aren't enough dwellings available at the moment. What does that lead to? This continued situation of supply and demand imbalance, and it impacts a lot on the rental market as well, because don't forget, people moving from overseas, whether they be students or not, generally will rent somewhere initially for the first 5 years, and the statistics back this up. So they're not going to be buying something anyway, but we're running out of places that are being offered for rent. And again, you can't just fix that by saying, look, we're going to pop in all this student accommodation in certain areas, because that only tackles a certain portion of that issue. So I think rents are going to remain higher for longer. Certainly as interest rates remain higher, that'll be the case. But potentially, even if we get a drop in rates, we still may have that supply-demand imbalance where there just aren't enough properties for rent. So I think rents will continue to remain higher for longer. And if you have a look at the rental market there, rent values, as you can see on that graph on the right, they've picked up again to an annual increase of 8.5%. And if you look at that from underlying units that make that up, I suppose, you've had an increase in the pace of growth in some of the regional house rents, and also growth in unit and capital city rents that has actually come off a bit, which makes sense because they've really kicked on. If you look there at the bottom, if you look at Perth, very strong obviously, but all of those markets, Adelaide, Brisbane, Melbourne and Sydney, there's been strong growth. And then obviously regional WA, you can see the graphs and you can see what's happening. And look, the rate of growth, I think, will start to moderate, as it should, hopefully, but it'll still be there. So if you're talking to someone who's trying to rent somewhere, it doesn't matter where they are, they're still finding it quite difficult and quite expensive. So the other interesting thing is that gross rental yields have actually moved higher in April, and that's the highest national result since October of 2019. As you can see, that was 3.77%, it's now 3.75%. And if you look at the yields, again at the bottom in the yellow bars, the rental yields, clearly Darwin's right out there in the Northern Territory in general, but that really is a function of capital values and of the major capitals. As is normally the case, the yield in Sydney is the lowest, and that's because the price of the dwellings is, generally speaking, the highest. So it's an inverse ratio. But I think, it's likely that, people who have got investment properties have been benefiting by this increase in rents, and we see that across the board, certainly across our client base. But obviously, it's not being able to match the increase in the amount of increase in their repayments due to higher interest rates. So it's a feature that helps. The other thing that's very important, of course, if you're a domestic property investor, so you're living in Australia and earning income in Australia, is that your tax deductions will increase with this impact of greater negative gearing, if you like. So there are lots of moving parts, and that's what people need to remember. That'll help you. If you're an expat, that won't help you right now in terms of your cash flows, but it is going to give you a greater amount of tax credits in the future. So how do we use the research, and what does all the data tell us? It's pretty important because everyone can go on Google if they've got a spare week or so and look at a whole lot of statistics, a whole lot of data, and probably walk away feeling fairly confused. People generally from overseas say to me, look, what's happening in the Aussie property market? And a lot of our viewers and friends will know that there is no Aussie property market. There are just so many of them. And I think that's what people forget. Now, if you're living in Dubai, sure, the Dubai property market is pretty much the Dubai property market. And Singapore may be the same, or Hong Kong. But, countries that are large, like Australia or the US, etc., that's not the case. So let's have a look at what's happened during prior tightening cycles. People forget to do these things, and I think it's really important because, as you can see from that graph there, if you have a look, quite often during tightening cycles, so monetary policy has been tightened by the Reserve Bank, you can see that values have actually increased, and in some instances there, as you can see, quite substantially. So we're seeing that at the moment, actually. We're seeing housing prices going up during this period of monetary policy tightening. And if you look at volumes, because that's also important, the CoreLogic estimates there show that on national annual count, there were 505,000 sales, or 38,000 bit over in April, coming through. So the levels are still fairly high. Compared to this time last year, they're up 7%, with capital city values up 9.2%, and regional sales up 3.9%. So any properties that are coming to market are transacting, and in most instances transacting very quickly. If you look at the change in sales volume, if you have a look at the bottom of that screen on the left, in Sydney, for example, this is in the 12 months to the end of April, volumes are up 15.5%. So pretty strongly, and that's being absorbed. So again, looking at different data in a more sort of intelligent manner, what's happened to house prices after the last interest rate rise in prior cycles? And as you can see, and perhaps in my mind, I think we saw the last interest rate rise in November. I know that many other economists may perhaps vary, and commentators have their own thoughts on this, but if that were the case, then we're in this first part of the chart here, house price change 1 year after the last hike. And as you can see, that sort of varied between -4 to 4.5% to up 14%, or pretty flat. But more importantly, and this is what I always talk to people about, because property is not really a 12-month investment by any stretch. So have a look at what happened over 2 and 5 years, and that's the important thing, I think, to look at. And these were during times when we don't face the supply-demand imbalance that we're currently facing, which is, it's quite extreme by historical terms. So it's something to bear in mind, that property prices, I think, are going to potentially be more elastic during this cycle than they have been in prior ones. All of our viewers will know the slide, and that's what we say in terms of property investments. So it's as easy as pie. It has nothing to do with our iconic food source, but population growth, infrastructure growth, and employment growth are the three key issues, I think, that people need to address when they're thinking about buying an investment property, and to make sure that's sustainable and available for the longer term. So, population growth. Now, you might have somewhere that has a massive explosion of population growth due to a single source economy. They've just discovered gold there, and they need a whole lot of people to go, but as that matures or cycles change, that may not remain in place. Similarly, you might have a massive amount of students come into a certain city, but is they going to remain there for the long term or not? These are the things we need to look at. how much infrastructure is in place on the drawing boards or being developed, because that's really important, because it helps people live somewhere, enjoy living there, and do it efficiently. And then, very importantly, what about employment? Not just current employment, but employment growth, because if you're going to have the population growth, you need the employment growth, because people can only move somewhere, generally speaking, if they have a job. So, really important to bear that in mind. And let's have a look then at the various markets around Australia, not all of them, but certainly the important ones. If we look at Sydney, New South Wales, it still has the most diversified economy in Australia. And what we're seeing now is, when I say the highest downside risk due to affordability, that's mainly on the sales side. And what potentially can happen though is you have a polarisation. So the really top end can still continue, to do well, because most of those people are not taking on any leverage or a huge amount of leverage. And also the cheaper portion, so the lower quartile, continue to expand because the affordability remains, but the middle quartile potentially can be impacted more so due to that affordability scenario playing out. There's still an ongoing and continued ongoing demand for quality. I think if you're a buyer in the Sydney market, it's very difficult. The quality house price growth has slowed, thankfully, for most people looking to buy, and immigration demand still remains the strongest, because it is, in a nominal sense, the area where most migrants will come to first. So if you look at Sydney there, in April, prices were up 0.4%, 1.1% over the quarter, so that's certainly starting to look a bit more beneficial for buyers. And over last year, it's been up 8.7%. Prices are just, they're 0.8% below their record, so just under their record high. Then if we have a look at Melbourne and Victoria, that's actually been a fairly slow market. There's been a massive boost to population growth due to immigration, because Melbourne's always, promoted its higher learning centres very well. They get a lot of overseas students coming in there. Rental affordability remains pretty good in Melbourne. Quarterly price growth has actually not grown, it's gone to zero. And overseas students at this point in time will certainly remain there. So if we look at it, Melbourne prices overall are 0.1% down over the month. They're flat over the quarter, and they're up 2.8% over the last 12 months to April, but they're currently 4.1% below their record high, which was, like most markets, reached in early 2022. Opposite to that, if we look at Perth in Western Australia, it's shot the lights up, had the strongest annual capital city price growth, highest population growth now, highest annual rent growth, and it's still showing affordability. So, that's, I guess, partially responsible for this, where Perth housing prices started from a far lower median position than most of the other capitals around Australia, barring Hobart. So if you look at Perth, up 2% in April, 6% in the quarter, and 21.1% over the last 12 months. And currently, unsurprisingly, Perth's property market is at a record high in terms of value. This is a question we get asked very often from clients, from other people. Should I be buying an old property or a new one? There's no correct answer to that. So, if you are going to buy an old property, then I guess what you need to look at potentially is, how can you add value by, say, renovation, redevelopment? Do you possess those skills? Do you have that time? And certainly for most of our clients and for most Australian expats, that's a difficult one. They're very time poor. They're generally not in the construction business where they've got the extra skill sets that could, I guess, beat someone in the local market who is a builder or developer. And so that may be difficult for them, but say you're nearing retirement, or in a situation where you've got spare time on your hands and you do have some skill sets in the construction sector, something that someone can look at. Then if you look at new, it suits, I guess, probably the majority of the people that we talk to, whether, again, you're a medical specialist, a lawyer, or an Australian expat. All those people don't have any skills in building or development. They have very little time, and they want a sort of no-touch experience if possible. It's generally speaking not, but a light touch experience. So if you're buying a new property built by a quality builder, you shouldn't have any issues with repairs and maintenance. I mean, there are builders' warranties. You're going to get better tenants more easily. It's easier to rent that out and manage it, where you're not going to have to worry about answering calls from property managers or disgruntled tenants. And that seems to work well for most of our clients. Then I suppose there's the added overlay. Now, it doesn't matter whether you're an Australian tax resident or an Australian expat living and working in another jurisdiction. The Division 43, Division 40 depreciation allowances in the Income Tax Act of Australia is a real benefit. So Division 43 basically says that if you spend $1 million on building a dwelling that you're renting out and creating assessable income from, you can deduct 2.5% of that $1 million, so $25,000 against your personal exertion income each and every year for the next 40 years. So it doesn't take much to work out the tax benefit that you derive from that. And then Division 40 are your sort of fixtures and fittings, chattels that can be moved. They have a half-life, and we ensure that our clients get a quantity surveyor's report done that they can utilise to claim all of their legitimate deductions on that basis when they submit their tax return at the end of the year. And for Australian expats, the carry forward, if you like, you can keep those tax credits. They don't have a half-life. You can then use them when either you repatriate to Australia and start earning personal income again here, and that's certainly very beneficial for, as most of our clients who do that can see, or if you sell a property or for other reasons, but you have that to take forward and carry forward. So what does all the data tell us? And as we said earlier, how do we use this? And it's been telling us a similar thing for a number of years now, and that is, where are you going to get your best bang for your buck, as it were, and is that sustainable? Because, as I said, property is not a short-term investment asset, it's a long-term investment asset. So what's going to happen in the next 12 to 18 months may not really be all that relevant. What's going to happen in the next 12 to 18 years certainly is. So what that tells us, or what the numbers continue to tell us, is that Brisbane and Queensland, that southeast Queensland triangle, is probably one of the better areas where you're going to get the best bang for your buck. And that's actually proven to be the case. So for a lot of our viewers and our clients over the years, they'll know that over the last few years, those I suppose tailwinds, the data that we've looked at, that we've said would have this impact, has indeed done that. And what's happened is that now, with price increases in Sydney, certainly, that valuation gap between Sydney and Brisbane has continued to grow. We're still continuing to see, the strongest interstate migration over 15 years into Queensland, and that's been sustainable and ongoing for many quarters now, and I think we'll continue to show that going forward. We've had an increase in percentage interstate migration to WA, but we'll have a look at the nominal, the underlying numbers in a minute. And the other part that's really important, I think, is that work from home lifestyle factor, where you have the coastal markets in southeast Queensland still, I think, contributing to that growth, because there are lots of industries, and I mean, we specialise potentially in the professional areas where, if you're a surgeon, you're not going to be able to do that from home, but many other industries in consulting and IT, finance, etc., a lot of that can be done on a remote basis. So people are adopting this hybrid approach, to their work, and their employers are allowing them to do that. And Queensland has a very well diversified economy, which people often forget. They think it's a mining state, but in fact it's more, I suppose, like the Australian economy as a whole, if you look at the sectors that contribute to GDP growth. So if you look at what's happened in Brisbane, values are up 0.9% in April, 3.1% over the quarter, and 16.1% over the last 12 months, and values are there now at a record high. So let's have a look at some of this, and I think it's pretty important, if you can see, and I read this out earlier, but WA has the highest rate of population growth currently, 3.3%, 2.9% for Victoria and 2.7% for Queensland. And if you look at the real numbers there, what does stand out to me certainly is if we look at the net interstate migration, New South Wales minus 33,000 people, Victoria minus 1,000, Queensland plus 32,600, South Australia minus 1,000, WA plus 11,000. So you can see the two standout numbers there from a positive viewpoint are Queensland and Western Australia. But then if we look at the overall situation, net overseas migration, New South Wales at 186,000 is far and away the largest. Victoria, and that's mainly Melbourne, 161, similarly very large. Now you see Queensland, 88,000, that's starting to move up, and WA, 67,000. So these are the numbers we need to look at, because it's the real people that need to have dwellings to move into. And I'll come to it later, but one thing within that is also that it's actually the average dwelling size in terms of number of people that's important. And that's moved down from 2.8 to 2.5, and people think, well, that's not really much of a difference. But it is indeed a very large difference in terms of the amount of dwellings that you need to house that population. So if you see that there on a graphical basis, you can see that the net interstate migration continues to outperform all the other states in Queensland. And as you can see there, New South Wales and Victoria show the largest population increase due to net overseas migration. Queensland's had the largest net addition to the population due to interstate migration. And it put this down there, it's worth noting that there are different housing choices that people make, and statistics show us this initially. If it's net interstate migration versus net overseas migration, if you're coming from overseas, most of those people are going to be renting for a longer period of time than people moving from one state of Australia to another. And that kind of makes a lot of sense when you think about it in a rational manner, because the people already living in Australia have probably checked out where they're going to move to far more closely, are very comfortable with that, may already have children at school, so all of those things are already feeding into their choices, and they're going to be ready to buy a dwelling much sooner, if not initially, as they move, than someone that's moving from another country and really isn't sure what they're going to be doing for the longer term. One of the things that people talk about, of course, are the next Olympics, which are being hosted in 2032 in Brisbane, and it's the Olympics and the Paralympics. And what are the economic outcomes from that? And they are obviously benefits. There's very strong infrastructure growth occurring currently, and also planned for that next 9-year period, that's going to assist with not just showcasing, I suppose, these sporting events, but enabling the state economy and the people living there to go about their lives in a more efficient manner. So a lot of infrastructure is being built in terms of traffic. We can go through the various projects that are in place now. But I think everyone knows that this is going to remain in play for a long time, and that's going to act as another tailwind to what's already happening in that economy and has been happening there, as we know and as we've shown people over the last, say, 3 to 4 years. This is just giving us a recap of what's happening in Brisbane in terms of current and future infrastructure projects, and they're massive. I mean, the under-river rail, the arenas that are being built both within the city, the convention centres, Suncorp Stadium, and then there are other venues in both the Gold Coast and Sunshine Coast and on the Hamilton River reaches within Brisbane. So all of these things that are occurring at the moment are going to continue to support both employment growth from an itinerant source, if you like, something that comes and goes, but then also the longer term, and I think that's the most important factor in terms of population growth, for people going to reside in these areas and be able to do that, be close to amenities, be able to get close to services very quickly, and have generally a better lifestyle than they might have in other areas. So if we look at those there, anyone that's been to Brisbane will know that a lot has been happening in that city. There's a great deal of vibrancy that's been created. The CBD in Brisbane is probably one of the most vibrant of any of the capital cities around Australia, and that continues to grow. The food and beverage sector there is actually doing pretty well and not suffering as much as in, say, Sydney or Melbourne or Canberra or other areas where people are cutting back on their discretionary spending far more because they're being squeezed, and this cost of living pressure that you hear about in the news is certainly very evident. So we can go through all of that with people in great detail, but there is just an enormous amount of development that's occurring there, and we can see the outcome of that already, having been baked in. So, places like the Howard Smith Wharves, etc., that really create that buzz and excitement within the city. So from our viewpoint, our client's viewpoint, what is the value proposition? What do we help with? And one of the things we help with, I suppose, is to assist people to try and not make the common mistakes that people will always continue to make, no matter how much information they glean. It's a situation that's a problem that we see on an ongoing basis. A lot of people buy into a strong market, so they buy into a market at its peak. Now, that may still be relevant if you're looking to live somewhere, but if you're looking to simply invest in this asset class, then that may not be perhaps the best time to buy into that market. So buy into the strong market of the future. Now people say, can I have some information? Sure, look, you can go on the internet these days and there's absolutely no lack of information. There are research reports published all of the time, but as I say, if you actually spend any time looking at a lot of this data, you're going to walk away on a very confused basis because quite often they can be conflicting reports about the same things. And people do still suffer at funds, especially with people who are very busy, that they get to a certain stage where they go, oh my God, I just want to do something and any investment will do. Well, it won't. I think you need to have a point of difference, and that needs to be sustainable so that you can really maximise the amount of capital growth you're going to get from this particular investment over the long term, and also to give you the greatest benefit in terms of generating income from that asset, i.e. Getting a rent that continues to grow and outperform perhaps the median levels of growth that you see in these markets. So that's really important. And the one at the bottom there, waiting too long to investors, is always, I think, very relevant because people can get blinded by information and research and just go around and around in circles. And we've seen this over the decades many times where people will wait and wait and wait to buy something only to wait and see that may have actually increased in value by over 50%. So it is really important, I think, to do it the other way and say, rather than wanting to buy something in a specific spot and watch that run away from you, that potentially you look at what assets are likely to give you a relatively good outcome over the next 5 to 10 years. And that's something that we try and really help people understand. So any property won't do, as I said. Beware of these single economic theme areas. Might be a mining town, could be something else. Beware of the lower quality investment stock that's supplied to the market, and they're generally, small units with difficult floor plates that go up in buildings where they've got, hundreds and hundreds of apartments, and a lot of them are the same in these dwellings. That's going to be difficult for you to maximise capital growth going forward, because there's no traction, there are no unique attributes, and generally speaking there'll be a lot of the same product on the market for sale or rent. So it doesn't matter where that is, that's something to look out for and steer clear of. And as we always try and tell people, go for the higher quality assets that people will continue to look for and pay higher rents for over the next 2 decades, not 2 years. So if you have a look at these markets with further granularity, and this is based on some research from Charter Kramer, and it relates to Brisbane. A lot of people forget that, but if you have a look at that graph, if you look at what's currently being built and is yet to come to market in Brisbane over the next 3 to 4 years, it is just so little, and it is so far below the amount of demand that's there, the amount of supply that needs to meet that demand. As you can see, completions are forecast just to increase in this 12 months as we see the casino complex being completed. But it's going to be 1,200 new dwellings that are going to be supplied in 2025. Now, that is just thousands below the demand that's already existing there, forgetting about new population growth. And as you can see, Brisbane's going to be suffering a shortfall of 25,000 new apartments over the next 4 years. I think people need to look at these numbers to give themselves a better understanding of what actually is going to occur within certain markets and then within certain areas of that. This is something that we've brought up since COVID, but it's very much in place now, and it has changed home buyer preferences. So people want more space, and people will do that in several ways, but from an asset viewpoint, they're going to buy freestanding houses or apartments that are larger, so 3 bedrooms plus a multi-purpose room, 2 bedrooms plus a multi-purpose room. There's obviously a preference for additional living spaces and working spaces, so that's a work from home situation playing out, and people might have a multi-purpose room that they turn into a home office. And certainly during COVID we had this increase for regional living, but that's now, I think, mean reverted, and now you've got the lifestyle precinct. So as I said, those the coastal markets in Queensland and New South Wales and Victoria are all benefiting from that, Queensland probably the most. And I think that's going to continue to dominate the market. And the other important area there is that people do have more money. With intergenerational transfer of wealth, there are more people with more cash, so whether they buy a new property without a loan or buy a more expensive property with a loan really becomes the salient talking point, and that's what we're seeing. So people will buy a much higher quality property and pay more because they have more cash to put in and can afford to do so. So if we try and put all that together, and that's what we do, we try and tie it all together for our clients, look for all of the things, as we said, the pie, the population growth, the employment growth, the infrastructure growth. What are the unique attributes of a property investment you're looking at? What's the future sustainability of that? How strong is that economic growth going to remain over the next decade? They're all the things that we try and think about and help our clients with. And as you can see from what we've run through so far, there's quite a bit to that. And it's not quite as simple as just picking up on a couple of issues and saying, I'll do that. So these are just some samples of the style of dwellings that we look for. Larger, higher quality apartments that are built mainly for owner-occupiers, downsizers, or professional couples with a child, or without a child, or perhaps with two. Coastal markets in Queensland, again, dwellings that have a high degree of amenity, high quality. Townhomes, something that a lot of our clients are looking for these days, where it's a sort of hybrid scenario between a freestanding home and apartment, but obviously far easier from a maintenance viewpoint, better from a security viewpoint. These are all the things that people tell us that they're looking for, and we see that in the marketplace. It's ongoing because these style of assets are in very short supply, and when they come to market, they tend to go these days really, really quickly. And just common sense, when you've got a lot of demand and very little supply, that's what will tend to happen. If we look at it from a quantitative viewpoint, and we do look at that obviously, generally speaking through property cycles, if you're an Australian tax resident, this is what the pie chart looks like. If you're buying an investment property, tenant will pay for the vast majority, tax offers for a pretty reasonable chunk, and you generally up for about 5 or 6%. Now we go through and model out a lot of the costs of acquisition and then the ongoing costs of ownership of those particular properties, so that people can actually understand what that means from a numerical viewpoint, how much money you need to put in or receive, depending largely these days on whether you are actually resident and earning taxable income in Australia or overseas, because in this instance, if you're an expat, some of those tax savings you won't be able to utilise now unless you have an existing portfolio of properties, in which case you may well be able to, because you're already deriving a reasonable amount of Australian taxable income, ATI. But generally speaking, if you look at this, there's a situation that might cost you $287 a week in this situation, or if you're living in Australia and utilising the tax benefits at the same time, it's actually a positive of around $60 a week. The end outcome will be pretty similar depending on the situation. It just depends on whether you utilise that now or in the future. So, for non-residents without sufficient Australian taxable income, you get to spend your tax savings when you repatriate or sell. And if you're an Australian tax resident, you get to do that on an ongoing basis at the moment, because you're paying a lot more Australian tax on your other income. This is a really important slide, and I bring it up at the end because as I've been going through this, I've been saying to people all the time, property is not a short-term investment that you should make. So people often say to me, oh look, I've got this extra money and I won't be needing it for another year, where should I buy? And generally speaking, I'll say, well, let's have a look at other things, but you probably shouldn't buy anywhere, because it's not a 12-month investment. There are lots of costs involved with buying and selling property, and things are cyclical and can change. So you're taking on a lot of risk with potentially not the reward over that short time frame. But what we see and what the statistics show us is, the highest level of sales that people make are generally between years 4 and 8. And you can see that graph at the bottom there. We see that sort of bulge there. Realistically, and this is why it's important to model things from a quantitative and cash flow basis, it's best if you can keep those properties that you're buying for the long term. Just ask anyone of your friends that has done so, or if you've done so yourself, you bought a property, 10 or 15 or 20 or more years ago, what's actually happened to that? Well, this top graph will show you that, because this is from September 21. the median hold period for resales across Australia was 8.8 years, but the median initial purchase price in December 2012, so 10 years prior, values went up over that period by nearly 62.5%. And you can see it there. If you want to keep a property for, 20 to 30 years plus, look at what's happening to the increase in the value of that asset. And a lot of people don't do that for the simple reason that they can't afford to. And that's where I think, the sort of help we can give people is really important. How do you make sure that you can afford to keep that asset? And there are lots of ways you can do that, through from financing to, yield growth, etc. These are the things that we help people with, but we've been doing it for a very long time. As I said initially, clients of ours can generally get an 85% loan without paying mortgage insurance to the bank, and we can do that for clients who are living in Australia or are Australian expats around the world, depending on whether they're employed or self-employed. Things like that will impact that, but that's a really important thing that we've been able to, I suppose, give our client base, and we've had lots of great feedback on that. Try and make it as tax efficient as possible, so it doesn't matter whether you're living in Australia or outside of Australia. Paying unnecessary tax is probably not something that people choose to do. They just end up doing it because they didn't know any better. And in terms of unique features of assets, exclusive properties, I think that's really important. And sustainability of those unique attributes is also very important, and will make the difference between potentially a bad outcome or an average outcome to a good outcome. What's next? Well, we assist people, all the time. If you have any questions or want to know something further yourselves, then please just email us or call us, and we can go through an initial meeting. We can arrange that on Zoom, and we can go through what your particular situation is, how we might be able to assist you, and then potentially look at implementing that in due course. There are contact details there, and look, if you'll be kind enough, please complete our survey that we'll send out for you and show us what we can do better. Give us any feedback, we really appreciate that, and assist us helping make these sessions better in the future. We also do, generally speaking, a weekly Q&A session, so if people have questions at any given point in time, email them to us and do our best to try and answer those for you, or arrange a meeting with yourselves over Zoom or have a call. Now let me just go there and see if anyone does have any questions.
Andrew, it's Gary here. Thank you for that. Really excellent. Question, Perth.
Yeah.
Perth is all quite bullish at the moment and has some pretty sustainable advantages, I think. Are you suggesting that we take a good look at Perth?
Look, I think, and brings back to that slide, Gary, as I said before, look at strong markets of the future. So I think you need to be just a little bit cognizant of that. Perth's had a very good run. It's come off a low base, but what we've got to look at, I've lived in Perth, and I've lived in many other cities around Australia as well. It's the issue that Perth has is that it's geographically really far removed from everywhere. So you just need to be a little bit careful of that. And I think Perth is a great market to buy into if you're potentially, looking to move to Perth. So I think in that situation, you'd say a definite yes. But if it's just for investment purposes, then as you can see now, because if you look at that, it's gone up over 21%, and on an annualised basis at the moment 24%. So you're probably doing what people do, and that's buying into that really strong market of now rather than the future.
Exactly.
Yeah.
Great. So that was Yeah, that was a rhetorical question, and I agree entirely with your assessment. Thank you.
I'm pleased that you do then, Gary. Thanks so much. All right. Well, look, we might say au revoir, and if anyone needs anything, as I said, please contact us. You can also then see this on our YouTube channel, and if you like this, please subscribe to that and click like, and I'll see you at the next quarterly review.